Hello and welcome to Policy Watch, your packed snapshot of the week's biggest business stories, their context, their relevance and impact. I'm Govindraj, Ethiraj. The big word is surprise. The Reserve Bank Governor Raghuram Rajan surprised everyone by cutting the repo rate, or the rate at which the Reserve Bank lends to commercial banks, by 50 basis points when most expected him to do a 25 basis points cut. The bigger question is, what impact will this rate cut have on you and your ability to pay off or take new loans? And more importantly, will banks pass on these rate cuts? Will the economy benefit?
It was expected for some time, with government and industry rooting hard for RBI cutting interest rates. But none expected it to be as big as this. For the fourth time this year, the central bank reduced repo rate by 50 basis points to a 4.5-year low of 6.75%. The cash reserve ratio was also kept stable at 4% as the reverse repo rate fell to 5.75%.
The Reserve Bank intends to be accommodative to the extent possible, given its inflation goals, while recognizing that continuing government policy implementation, structural reforms, and corporate actions leading to higher productivity will be the primary impetus for sustainable growth.
RBI justified the rate cut, saying consumer inflation remains below the 6% target laid down for January next year. The centre welcomed it while clarifying it would reassess the GDP target after RBI revised it to 7.4%.
This decision of the RBI will significantly provide policy support to the real economy and help in the recovery process.
Within hours of the RBI announcement, banks announced just what the consumer long looked for: reduced lending rates and lower EMIs. SBI reduced its lending rate by 0.4% to 9.3%. Andhra Bank also cut its lending rates by 0.25%. Ahead of the festive season, definitive measures to give the economy a much-needed push. Bureau Report, Rajya Sabha Television.
Joining me in the studio, Saugata Bhattacharya, Chief Economist at Axis Bank, and Atul Joshi, Managing Director of India Ratings and Research. Gentlemen, thank you very much for joining us. Saugata, let me begin with you. You said that a 25 basis point cut was almost a given, right? So, but yet you did not expect a 50 basis points cut, which obviously caught you and your ilk by surprise.
Right. I'm just very glad that we were not one of the few who said no cuts.
Yeah.
But I mean, 25 was a done deal, as we said. That the governor, all the conditions, the bulk of the conditions, the guidance that the governor had given in early August had been met. We know the uncertainties had been resolved, at least, I mean, whatever the state of the monsoons, the rains, we knew that was done. It was a surprise, that 50 basis point. I mean, obviously, I mean, they front-loaded it on the expectation that the US Fed would take some time to hike. And let's get this thing over and done with, because before the volatility of that hike started.
Right. So are you saying that the external fear in some ways or concern was outweighed the domestic factors?
Not really. I think it's more the way that you would look at this is that they saw a chance. And the global environment is such that fears of inflation coming up, commodity prices moving up, that probability is relatively low, I presume.
Okay.
So they took the chance that commodity inflation would remain relatively contained, and it was time to shift focus to growth. Remember, the central banks will always work with a time horizon in mind, with a forward-looking view in mind.
Right.
And I think, as somebody asked him during the question hour session, that was this a shock and awe approach to getting banks to cut and other effects, surprise effects? He said no, that central bankers don't work on a shock and awe. We took a considered decision, and the decision was a 50 basis point.
Okay, Atul, let me come to you. So the question sort of which leads from the previous one is this a somewhat panic move in a way? I mean, maybe panic is a bit of an overstretch, but a move that is driven out of concern, or is it a calibrated move?
No, I think it's a calibrated move. We have seen that there is a lot of clamor about interest rates not being reduced by RBI in time frame. Given the corporate leverage where it is today, if you look at the top 500, the average leverage is in excess of 4.5 times. So this is absolute necessity if we want to get into an investment cycle little earlier. If the corporates continue to remain with such a high leverage, the interest coverage ratio itself is so poor that there is nothing left for them to invest. So this is a huge breather for the corporate world. And if you look at what the banks have been busy with, the banks have been quite busy with building up their retail assets portfolio. Now, the retail consumers could be broken up into two: those who have already borrowed and their interest rates are either floating or are fixed for a certain time and then reset. In both the cases, the retail consumers would tend to benefit, leaving a little more headroom for them to consume, and then the consumption cycle could to somewhat extent be revived. As far as the other retail consumers who have not already borrowed, for them it's a kind of sitting on the fence, and now there is an incentive for them to come in and borrow either for housing loan or for vehicle loans or for personal loans. So I think this is a very calibrated move to ensure that the corporate world benefits in terms of given their leverage position, and the retail consumers are able to borrow more and also save on their existing loans and consume more.
Right. So Atul, what does the 50 basis points, of which only a part will get transmitted, maybe a little more than half, but surely not all, actually do to some of these leverage balance sheets that you spoke about?
So I guess this time you would see on an average at least 25 basis points rate cut. And I would like to divide banks into two portions. One, those who have ability in terms of the capital headroom and the willingness to grow aggressively. So these banks would be able to cut a lot more, between 25 to 40 basis points. And those who have capital constraints and will not be able to grow more, they would probably be satisfied with just about 25 basis points rate cut. But across the industry, you would definitely see a 25 basis points rate cut on an average.
Let me come to you, Saugata. So there was also a problem of slowing credit growth, right? Sure. We had about 9% as compared to 11%. Right. So how does this actually get spurred up? I mean, or is this enough, more importantly?
No, it will get spurred. Remember that, I mean, if you look at the cumulative cuts that have happened in the bank lending rates, the base rates, that's almost 75 to 90 basis points across banks.
No, my question is, if we are on a steady decline when it comes to credit growth, economic growth, investment, capex cycle and all of that, should it take, it's almost like turning around a super tanker, right? So in that sense, maybe is this a...
Obviously, because I mean, even Governor mentioned that, I mean, even after the transmission of the repo rate into the bank base rates, for that to transmit into real activity, which is where credit growth will begin to happen, will take another 6 months to 9 months. Okay. Because I mean, once rates fall, and I'm not talking of retail assets, I mean, where housing loan, auto loans, large ticket, SME, mid-corporate, large corporate loans, they will have to go through the process of financial, once the new sanctions come in, so that entire process will take some time. In the meantime, one is the supply of credit, which is cheaper. The other is the demand for credit, because I mean, as the monetary policy report also mentioned, capacity utilization is still about 70-72%. As Atul also mentioned, I mean, there is a huge amount of leverage still sitting on corporate books. Some bank balance sheets are also stressed, particularly in some banks. So, I mean, there is this demand-supply thing which needs to work through the system. Capex will take its own time. The government is beginning to work on a significant capex programs, roads, for instance. So, I mean, demand will come back.
Right. So let me ask the counter question to that. So, are we trying to fix a problem, for instance, of stressed assets, with the wrong medicine, which is in this case an interest rate cut?
No, I think this is an enabler. The interest rate cuts is an enabler for banks to pass on some of the lower costs of funds that have happened in the system. Remember, there are a lot of projects that happen with a certain hurdle rate. So the moment the hurdle rate comes down by 90 basis points or so, and in time the full 125 basis points, once that hurdle rate comes down, many projects that were unfeasible at that higher hurdle rate will suddenly become feasible. So the new projects will come into the pipeline. And this is an enabler. Together with this, I mean, all the other mechanisms that the RBI is trying. I mean, the current RBI has done a lot in terms of getting more flexibility in terms of restructuring assets.
Right. And I want to also come to some of the other moves that the Reserve Bank announced in addition to the credit policy, but I'll come to that in a moment. Atul, you know, we have private capital expenditure and we have public capital expenditure. Private capital expenditure has obviously slowed down, but public capital expenditure has stepped up. In the moment, whether it fills the gap is not very clear. What's your sense? I mean, does this interest rate cut help, push or accelerate the overall capital expenditure?
No, I don't think the rate cut itself could spur the capital expenditure on the private side. What it actually does is that it would create consumption ability in the hands of the ultimate consumers, and that could improve the capacity utilization much faster than what is expected to be. On the public side, I think it's the government's ability to spend, and there the incentive of 25 basis points rate cut is not really going to be a crucial decision making factor. Or even, for example, even if the RBI cuts by 1 percentage point, that will not be a reason. There has to be a demand on one side for the corporate sector, but on the government side, there is an obligation to develop infrastructure and push the investment cycle. So I guess the government would do the expenditure irrespective of where the interest rates are. The breather is the rate cuts, in terms of you are able to incrementally save some money on that. The cost of capital, the cost of setting up the infrastructure could be slightly lower, but it's not a crucial factor for decision making. Private sector, as I already said, it's kind of a breather, and from the consumption side, it might accelerate the capacity utilization numbers then in the normal cycle.
If we were to look at, Saugata, the state of the economy today, and some of it is obviously weak, the government, or the Reserve Bank, sorry, has even lowered the GDP forecast, albeit only by 0.2%. What's your prognosis? How from here on, since some things are going right, including lower commodity prices, could things look up for the economy as a whole?
I'm quite positive. I think, it is almost a given that economic growth will improve in H2. I think, some capex will begin to move. The government is putting in place, through investments in roads, increasingly through railways, defense, inland waterways, and is significant. And the government also benefits from the rate cuts, because remember, the cost of borrowing has come down over the past year and a half, from 8.5 down now currently to about 7.6, and onwards, it will come down even more. So they save more than 75 to 80 basis points on their cost of funds.
Right.
So their ability to spend more of the saving that would otherwise have gone into
So one
interest.
quick word on the other non-credit policy or monetary policy moves, opening up the bond market for foreign portfolio investment.
Yes, I think it's a very, very important move. One is the entire FDI limits into bonds that will serve probably even more than the interest rate, the repo rate cut, that will serve to bring down government yields even further from the current levels. And secondly, things that have come off the monetary policy, the partial credit enhancement for corporate bonds, say for instance. I think this is a very significant move, because remember, in corporate bonds, these infrastructure SPVs, which are typically rated BBB and BBB minus, which were not part of the portfolios of the big pension funds and so on. With this credit enhancement, it might, there are problems with the mechanisms, but essentially this is the move forward in getting these ratings up into the AA category, where more money from pension fund money will begin to flow.
Right.
And I think this is a very significant move.
Right. Quick last word, Atul, last two words actually. Unfinished agenda from here on.
I guess the unfinished agenda, while 2-3 things. One is that the government has, the RBI said that it's accommodative policy, but I see lack of some benchmarks or some road signals as to overall what kind of time frame such accommodative policy could continue, whether it is 12 months, 18 months, 36 months. That's one piece. Second, I guess while the RBI has opened up FPIs for the debt investments, both at central level and the state level, I am still not very sure that in a QE kind of situation or a QE withdrawal kind of situation, what kind of safety valves the RBI has built in to protect the rupee. A little bit of global uncertainty and a portfolio outflows, and rupee really goes through a volatile phase. I think that's not really a very great situation to be. So presently, while we can really appraise, we can really praise RBI for opening up the market, but I guess we have not provided for the volatility. So that should be another piece where RBI should probably make some comment on where their expectation of the currency is between now and over the next 12 to 18 months.
Right. Okay. Saugata, the last word. Unfinished
agenda.
Yeah.
Two. The same things that we repeat again and again. One, if they can get the GST passed, the government can get the GST passed, and the bankruptcy law. I think the bankruptcy is a very, very critical reform measure.
And you're going for a break. On the other side, we talk about the new foreign direct investment numbers. Is India really doing that well? Stay with us. Welcome back to Policy Watch. India has overtaken China in expected greenfield foreign direct investment flows to become the largest destination in the last 6 months. A data consultancy owned by the Financial Times newspaper has said India received $31 billion in foreign capital flows, while China was ranked second at $28 billion. Now, while there is some debate on these numbers, the larger question is, are investment flows into India turning the corner, and what will it take to convert the Make in India effort to substantial on-ground investment? Joining me to do that discussion, Ambreesh, Baliga, market analyst, and Madan, Sabnavis, chief economist at Care Ratings.
India leads both China and the US as top destination for foreign direct investment. A Financial Times report says India received direct foreign capital inflows of $31 billion in the first 6 months of 2015. India is at number 1 in a ranking of the top destinations for greenfield investment measured by estimated capital expenditure in the first half of 2015. India attracted roughly $3 billion more than China and $4 billion more than the US. There's been a jump of over 150% in FDI into India in the first 6 months of 2015 as compared to FDI in the same period last year. This is significant because 97 out of a total of 154 emerging economies have registered a year-on-year decline in greenfield projects. Last year, India ranked 5th behind leader China that had foreign direct investment worth $75 billion. The US and the UK were also ahead of India. Last week, the government had announced that it would further simplify the FDI policy.
The effort is to have a simple and progressive FDI policy, move in the direction of more sectoral reforms, move in the direction of liberalizing the sectoral caps, and eventually have a policy that is simple, progressive, easily understood.
A quantum jump in FDI receipts would help the government respond to opposition charges on Prime Minister Modi's frequent foreign tours. Krishnanand Tripathi's report for Rajya Sabha Television.
Well, joining me to understand where these foreign direct investments are going and what is the likely outlook for both foreign direct investment as well as portfolio investment, I'm joined by Madan, Sabnavis, chief economist at CARE, and also by Ambreesh, Baliga, market expert. Gentlemen, thank you very much for joining us. Let me begin with you, Ambreesh. So we, saw a peak in terms of concerns in the market. We had the China factor, Greece factor. That was a while ago, but all of that was affecting potential portfolio flows into India. Where do we stand today before we look at this new figure?
The portfolio flows are still affected. If you're talking about FIIs, the flows are still affected. But then, fortunately, what had not happened in the last 20 years, what we are seeing as of now, is huge domestic flows. And that is increasing day by day. And I think that is what is supporting the market, and I think will support the market even going ahead.
Okay. Madan, can I come to you? How are you seeing the new FDI numbers, the $31 billion for India compared to $28 billion in China for the first half of 2015?
Actually, Govind, if you look at the numbers which have been put up by DIPP, they are quite different from this $31 billion which you're talking of. So evidently, there's a different source from which this particular data has been procured. Now, this said, I think we have to appreciate the fact that ever since this government has come to power, they have done a lot to make sure that doing business becomes easier in the country. And that's one of the reasons why we have seen higher inflows coming in. And the second part, of course, is that with a kind of a slowdown which we're seeing in China, and there's apprehension that growth could slide even further, investors would definitely see India as a better choice, given the fact that we are sort of in a position where growth will only move upwards and not downwards, unlike China, which it's the other way around.
So for a moment, Madan, on these figures themselves, right, there is a contradiction between what the Financial Times numbers are and what India's own DIPP says. But the larger issue is how much of this money is coming and where is it going?
No, to my mind, I think most of the money which is coming in is going more towards the service sector and infrastructure. We're not really seeing any kind of divergence or rather diversification into the other sectors of the economy. So even if I'm saying from where is this money coming, it seems to be from the Mauritius, Singapore, maybe a bit coming from UK. And in terms of which are the sectors, services, telecom, banking, other financial services. So it's not that kind of broad-based kind of FDI which is going in. And also we should remember that ever since last year, the government has tried to open up the doors for foreign direct investment into defense and railway equipment, but we haven't seen anything much coming in those sectors.
Right. Okay. So we'll come back to the larger question of where this money is going and the diversification of these flows. Ambreesh, if you were to look at portfolio investment now, let's sum up what or how things have been moving along in the last week or so.
No, I mean, like the last couple of months, in fact, we have seen outflows by the FIs, and this is quite natural that when you have concerns on emerging markets, I mean, India also falls within that. So, irrespective of the performance of the Indian economy or the Indian corporates, money flows out, and that's exactly what we've seen.
Okay, Madan, you know, we obviously are also in the midst of a fairly concerted Make in India campaign, which is trying to attract investment, both domestic and overseas, into Indian manufacturing. Now, whether or not we agree with these figures, how would you sort of rate that effort so far?
Yeah, if you're looking at what kind of investment has really been coming in real terms, it's been not as significant as what's been done in terms of the policy front, both in terms of domestic investment as well as foreign investment. In fact, if you look at domestic investment, we haven't really seen any signs of takeoff. I think everybody is waiting for the government to initiate the process of investing in infrastructure before it really has backward linkages. And as I mentioned, as far as foreign direct investment is concerned, it's still restricted to the same kind of territories where they were going in earlier.
Okay, let's look forward, Madan and Ambreesh. So, if you were to say that okay, we have a Make in India target, we are also seeing slowdown in FDI in countries like China, which could potentially attract what could maybe go to India. What's the task ahead?
From my point of view, I would say that Make in India is more of a slogan where the government is trying to get in the policies for doing business easier. It doesn't go beyond that because if you're talking of any kind of real investment Make in India is not a part of it. It's more a case of saying that the government will be a facilitator and the private sector will have to take it on and start investing. Now, if you look at the private sector, there is not too much of incentive for them to invest, especially if you're talking of manufacturing, because if you look at average industry capacity utilization rate is around 71-72%. And given the fact that demand conditions are still fairly lackluster, there's little incentive for people to start investing at this point of time. So therefore, I would be a bit cautious when I'm interpreting.
How are things stacking up in a global context? So for us to either be a recipient or perhaps see other people being a recipient of direct investments.
See, if we're talking in terms of whether foreigners are looking at India because of Chinese slowdown, yes, to a certain extent, India seems to be a more exciting proposition. But if we're talking of the overall quantity of funds which are there to be invested, to my mind, that would get restricted to the extent that we've already seen the quantitative easing program of the US ending, there's possibility of the interest rates going up. So I think even in terms of the reservoir of funds which were going into the emerging markets, that has come down. And while India could definitely benefit more than the other emerging markets, it's not going to be significantly higher than what it was earlier.
So would you concur, Ambreesh, the fact that we are not necessarily a large recipient or likely to be a large recipient of funds, even despite the fact that it's sort of thinning away in other markets?
No, I think finally, over the next couple of years, we would become, I think, one of the larger recipients of the funds. Because end of the day, there is a pool of money to be invested worldwide. And generally, this finds its way into those markets which are performing relatively better. And today, we are in a very sweet spot. The question is whether we are able to utilize that or not. And that completely depends on as to how the government reacts to the whole thing. And from whatever the government has been talking of, whatever Mr. Modi has been talking of, I mean, he clearly mentioned that the world will not wait for India. I think that clearly shows the sort of urgency which is there within the government to set the things rolling. And once the ball starts rolling, which I expect to happen over the next couple of months, I think you'll clearly see the results over the next 12 to 15 months. And that is when you'll actually see money flowing into India as FDI and FI.
Right, and that's an important point because you're saying essentially that investors really invest in the long term. And if they feel there is long-term vision or commitment, they would continue to invest.
Absolutely.
So let's take the next step, right? So if we were to say that in general, India appears like a good emerging market play, both for direct and portfolio, what are the areas that are currently looking stronger and with more promise, even if the macroeconomic signals are weak?
No, in fact, where the money would finally flow in to start off with would be the infrastructure space. And that is what is lacking in India, and that is what has to be kicked off. And once the infra space kicks off, automatically the rest of the sectors around it will start performing. And automatically, because of that, the economy itself will start performing much better. So I think that's one space where money would start flowing in. As of now, what we are seeing is decent amount of money is flowing into e-commerce, which is not really going into asset creation. What we require today is asset creation, and that will happen via infrastructure and once you start building capacities.
No, but are you saying that as an opportunity, or are you saying that that's a concern area because it's not coming?
No, that's a concern as well as an opportunity.
Okay.
The concern can be converted into the opportunity in case the government acts fast.
Right. Okay. Madan, let me put the same question to you. Assuming there is this bucket of funds lying somewhere. It could potentially come to India. Macroeconomic signals are somewhat weak, but there could be specific areas where there is opportunity and maybe worth taking a little bit of a punt compared to maybe previous occasions. What would those areas be?
See, if we're looking at foreign investment, I think they take a long-term view. Now, currently, India appears to be one of the better options because we're really poised for higher growth. If we're talking of which are the sectors, it should ideally be coming from the manufacturing sector. But as I mentioned earlier, manufacturing has its own limitations as of now. And until there is a turnaround in domestic investment, I don't think there's going to be too much of foreign investment coming in. So for the time being, at least for the next 1 or 2 years, to my mind, it will be again back to the services sector, financial sector, financial services, including banking, telecom, and probably even the e-commerce, which Ambreesh was talking of. I think that's where it's going to be concentrated, at least in the short run.
Madan, you're saying that domestic investment to some extent is a precursor to increased or accelerated direct investment from overseas. Am I right?
Yes, in terms of manufacturing, it will definitely be a precursor, but for services, not necessarily so.
Do you see a similar phenomenon in portfolio? Because you did say that it's really domestic investment that's propping up the markets.
No, but this domestic investment, whatever is coming in, is not from the entrepreneurs. It is basically from the retail investors who are finding that the equity markets possibly are giving much better returns. And that's what they have
But that's a good early sign, isn't it?
Absolutely. So I think this is what will possibly kickstart. And then we need to see as to what the government does. See, I mean, the way I see it is, if government walks one step, I think the private entrepreneurs will walk 2 steps.
Okay.
But without...
So give me an illustration.
I mean, again, we are talking of a public-private partnership in infrastructure. Today, if you ask any of the entrepreneurs to put money in infrastructure where they have burnt fingers in the last 4-5 years, I don't think anyone will put a single pie. But if the government takes it forward, puts in part of the money, gets foreign like investors to put in some part, and then you can see the rest of the money will come from the Indian entrepreneurs. But without that, if you ask the Indian entrepreneurs, create a scenario for them to start investing, I don't think anyone is going to write out a check. And that's exactly what we have seen in the last 1 year, 1.5 years, that no one wants to write a check.
Right. But on the other hand, to give the government credit, it's also taking the onus and actually starting to pump prime the economy in a way, at least when it comes to infrastructure. It's saying, let's not get into painful PPPs, but let's go and fund ECC contracts and so on directly. Yeah, but
that's what I'm saying. The money has to start coming in from the government to start off with.
Yeah.
I mean, creating the environment itself is not enough. Okay. I mean, which is what they've been trying to do for a while.
Right.
But we are still not seeing the Indian entrepreneurs putting in money.
Right. Okay. So, Madan, if I got the sequence right, so domestic investors led by entrepreneurs have to put in more money, or in entrepreneurs and retail, followed by perhaps direct investments, and hopefully in the domestic context, the government should be really leading the effort, and that sets off the chain, which has, of course, happened in many occasions in the past.
Yes, definitely. I think it'll have to be the starting point from the government sector, followed by the domestic investment, and once these two things are upbeat, especially in the infrastructure and manufacturing space, then we could be expecting more FDI to come into these sectors.
So, to sum up quickly, Ambreesh, so what should we really focusing on now if you were to go ahead? So, therefore, I understand that we should not be rejoicing with these new FDI numbers. We should be instead focusing on.
I mean, these are only numbers for discussion.
Right.
I think we have to start off with infrastructure. That is what is lacking. Without infrastructure, you cannot have Make in India. You can create capacities, but how do those capacities of manufactured goods reach the port? You require infrastructure. So you have to start off with infrastructure. Next would be the capacity building. And then the rest of the economy starts moving.
Right. So, Madan, last word. What's the task forward?
See, the task forward is really to make sure that we maintain the status quo as far as FDI is concerned, try and increase it in the short run. Now, we seem to be getting around $30 to $40 billion on an annual basis. That's been a trend in the past. Let's try and make sure that we can push it into the $40 to $50 billion range. And for that, I think we need to have more proactive steps being taken by the government, especially in the new sectors like insurance, defense, or railways, which we had enhanced the limits last year.
The conclusion, as I take it, is direct investment may come or will continue to come, but the important thing is to keep government spending high so as to trigger the next round of investments from domestic investors and entrepreneurs, and then again will lead to more investment coming in, particularly from overseas. That's the bottom line.
Absolutely.
Right. Thank you so much. We've run out of time. That's all we have time on Policy Watch this week. We'll be back next week, same time. Thanks for watching.